Hi guys, Girolamo Aloe here, and today I want to talk about liquidity and markets. What is the relation between them? So, in a liquid market, there is a high number of negotiation, a big number of negotiation time by time. This is obvious, and this is what moves the price. Even if you don't see that the market is concretely moving in a consistent way, you know that the price is going up and down continually because there is a high number of negotiation time by time. This is normal. And this is what makes a liquid market really easy to trade, and of course also not particularly difficult to enter the market and to exit the market, considering also that the time to get a trade in profit can be also very fast. In a non-liquid market instead we have something different, but liquid market and non-liquid market use and follows the same rules. In a non-liquid market we see that there is a very low number of negotiations. This is caused because the market is not interesting for investors. So when you want to trade a non-liquid market, you need a cause to see people that are induced to enter the market. So there is a particular catalyst that causes volatility in the market. So this particular catalyst induces people to enter the market. People, investors, sponsor of the stock, and so on, to enter the market and move the market. So, what are these particular catalysts? There are many things that you can consider just following the Yahoo Finance news and so on. Stocks are pumped concretely, especially the penny stocks, and they give a lot of profit when they are pumped because they give you, they induce people induce you to enter the market because they are just pumping these, are giving rumors about these, are giving questions, are just telling that the price can go somewhere and so on. So you are induced to enter the market and going to take shares in the market. In this way, the securities that you take just move the price high this way. So this is a pumping. What is the dumping? When the pumping is completed, you are now in a situation where there is nothing more that push up the price. So the price is going to be abandoned. I mean that the price level that the shares has reached cannot be sustained longer because there is no more people that are pumping the price this way. So at that moment there is no more demand. The demand has become very weak and the price now is declining because at that point there is the liquidation. People, investors and sponsors are giving away the securities, and giving away the securities the price goes to decline. In a liquid market instead this is not happen concretely, and the liquid market of course has the demand and the supply not ruled by a simple catalyst. The catalyst concretely just give nothing. Or better, every catalyst that you have in a liquid market is just going to favor the market makers to move the price in a specific direction. If the price is bearish, a classic catalyst doesn't change this trend. If the price is bullish, the catalyst doesn't change this behavior concretely. It can give a spike on the price, but the price later will continue the direction that it had because the strength of the distribution and the strength of accumulation are just driving the market. They are driving the market. You have to understand one simple thing. The market are always driven. The market are not casual. They are always driven by some investors, big investors that use money for a specific purpose. And the driving of the market doesn't depend on the catalyst if the market is liquid. If the market is non-liquid, the catalyst can move the market. This is to consider. So if I want to invest in a liquid market, I find that this is for me very, very easy because the market moves, so I can earn money easily and also quickly if the market has enough volatility. Another thing to consider is the capitalization of the stocks where I'm going to invest. If I'm going to invest on stocks that have a very high capitalization and of course are very liquid in the market, I see that the price is moving concretely and with enough strength, but I see also that the profitability for the trades in this market is not really so big because the market is so liquid that the market moves slowly. And this tells to me that I have to use an high leverage or invest a lot of money. Instead, if I go to a non-liquid market, I have something different. The market is not liquid, the market is just abandoned. But when there is a catalyst that is inducing people to invest in the market, the market spikes up or spikes down, depends of the catalyst. But the market can concretely spikes, and then this spike is consistent. It is limited in time, it can have a duration of some days, but this is consistent. So this moves the price for some days, a few days, giving to the market a very big difference in percentage. That the price change at the end of the spike will be very big. This is important too. If you can invest a small amount of money on a non-liquid market and in small capitalized stocks and get a lot of money. You can invest instead a lot of money on a high capitalized stock and that has a very liquid market and get just a few percentage of reward. So these two things are concretely important. Liquid market and a liquid market are opportunities together. I used to invest in penny stocks, futures, of course in Forex, because this is the easiest marketplace and this is what gives me the money. My investment and my skills to make this, and so on. So guys, if you have questions, please contact me. I will try to answer, I will try to give you much more explanation. And please guys, follow me on my YouTube channel, on my Facebook fan page and my Instagram television. I give this show every day. And please, just spread around, invite your friend. This is not about money, this is just sharing my knowledge and so many years I spent to make this job properly. Thank you guys to listen to my words, thank you to be here and see you next time. Bye bye.